Well, thanks for joining us today. My name is Bruce Apted and I'm the Head of Active Quantitative Equities for Australia for State Street Global Advisors. And in today's session, what we're going to be talking about is we're going to have a quick look at the macro environment and just point out some of the things we're seeing in the macro environment. Then we're actually going to talk about our investment approach and how we like to invest. And then finally, we're going to talk to why we think it's an interesting time to be looking at a style of investment in terms of how we like to invest. So with that in mind, let's turn to the current market environment. We all know that it's been an extended cycle. The US economy has been growing now for 124 months, and that's the longest since the 1960s. The Australian economy has actually even been growing for longer. So it's been a very long, extended cycle. And that causes some concern for some investors. And we recognise some of those concerns as well. So in addition to it being an extended cycle, more recently we have had a number of warning signs. So the trade wars have obviously been disruptive to the global economy, and we see that through the manufacturing activity indices that we follow. In addition to that, we've also seen other things that have gained some attention and actually also foreboding as well. So the yield curve has been something that a lot of people have focused on. As it's been declining and getting closer to zero, that is raising concerns about future growth prospects. Of course, earnings, what's been going on with earnings? We've seen that earnings have been rebasing lower since very high levels in 2017. They're actually quite similar trends to what we've been seeing in manufacturing. Now, the central banks have responded to this slowdown. So globally, we have seen central banks being much more accommodative, and we've seen rate cuts coming through and accommodative policy settings. And the markets have responded to that more accommodative stance. So we've seen, particularly this year, equity markets across the world have rallied significantly. They've done that without their earnings going up. They've actually just extended those valuations, and this is now posing a risk that we see within the markets and something we wanted to point out. So if we just give a bit more colour on what we're seeing in terms of those extended valuations, we've got a slide here that looks at the PE multiples at 2 points in time. The first point in time is September 2018. Now, if you wind your mind back to September 2018, that was just before we had the Q4 correction. So it was kind of like a minor peak within the markets. And at that point, the MSCI was trading at 15.6 times, and the S&P ASX 300 was trading at 15.5 times. Fast forward to the 28th of November 2019, and what we see is those valuations have actually gone even higher than what they were in that peak in September of 2018. And when we look through that table, you can actually see that it's quite broad-based. So almost every single sector is now trading at more expensive multiples. The sectors that have expanded even further actually tend to be the more expensive ones. There's only one sector that hasn't, and that's the materials sector. So it's been very much, the central bank activity has really created an environment where all boats have floated higher. That final column is worth touching on just quickly. So what we like to look at is the earnings trends, and so whether analysts are revising their expectations up or down with respect to next year's earnings. And essentially we can look at a statistic that shows whether those trends are positive or negative. And very easily you can see that there's lots of red in that final column, showing that there's actually negative trends. So we've had this valuation uplift at the same time that earnings have actually been getting downgraded across the board in general. Now, one thing we do know is that across the market there's always opportunities, and that's, I think, a good segue into thinking our investment process and how we like to invest. So let's turn to that now. When we think about our investment approach, what's most important to us is what is important to the end investor. And we believe the end investor cares about two things primarily. They are both growing their assets over time, but also equally guarding their assets over time. So how do we translate those objectives into our investment process? So what we do is we think about what is the return potential for the stock, but equally what is the risk associated with that return potential. We're benchmark unaware, we're high conviction, we're looking for just the best opportunities. Now, best opportunities, what does that mean? So for us, we need to assess the opportunities across 4 dimensions. So we're thinking about the quality of the business. That's a really key element to understand what the business's prospects are for the future and how sustainable is it. Equally, we care about the valuations of those securities. The key driver of the price you pay for a security is a key driver of the returns you will end up getting out of those investments. We care about the shorter term dynamics around those businesses because that's very important in getting the timing right in these investments. And finally, we care very explicitly about the risk associated with them. So there's 4 elements there that allow us to map where we see the opportunity set in the ASX 300 on any given day. So let's turn to that in the next slide. This next slide is what we call our bubble chart. And there's quite a bit going on here, so let me just talk you through what we're looking at. So the first thing is the yellow dots represent the weights that we're seeing in our current portfolio across the ASX 300. And the blue dots show the weights in the ASX 300 to those stocks that we're not investing in. There's 2 axes on there. The first one on the left-hand side is the return dimension. So we're saying whether we think that stock has good return potential or low return potential. And then on the bottom there, we're saying where we see the stocks in terms of the risk potential. So you can see quite visually, quite clearly, the yellow dots tend to be up in that top left-hand quadrant, and that's where we would prefer to be investing. And we've called out some of the names there. We've got Sonic Healthcare there as a name that we've been invested in, and it's been a good position for us. Horizon's another one listed there. We've also got Fortescue Mining and also some of the property trusts as well as Telstra. So that's our bubble chart. That's where we see our investment opportunity set in terms of investing in that top left quadrant. Now, when we invest in that through this investment process, and when we invest with this lens, we get certain outcomes. And this is something we like to talk to our investors about because we have a certain style of investing. It has certain outcomes, and we want our investors to know when we're likely to do well and when we're likely to do badly and what environment we're really suited to. So one of the ways we can think about our return profile is about how much we expect to capture on the upside versus how much we expect to capture when the markets go down. We call this our upside-downside capture ratios, and we typically see that we capture about 80% of it on the upside, but equally on the downside we only capture 58% or close to 60%. So when we tell people we only capture 80% of the upside, people often say, well, that's not that impressive, Bruce. Surely you can do better than that. But really where the power of our strategy comes in is not on the upside capture, but it's more on not going down as much when the market has down months. And now what's really important to understand with that is that markets have down months quite a lot. So if you've got a strategy that actually can outperform when markets go down and that occurs enough times, then you've got an edge that's enduring. So we've got a statistic for you there. It's 43% of the time we see down months in markets. I just want to tell you what that's based on. So that's based on data on the Dow Jones Price Index going back to 1900. So it's almost 120 years of history where we're looking at how often you have down months, and it comes out at 43% of the time. So they're the 2 things to understand. Now, when we look at our performance of the fund, we've got that on the next slide. We're comparing the performance of the fund to the ASX 300, and you can see that we've outperformed the ASX 300. But what we wanted to draw your attention to was not just the outperformance, but really actually when we get the outperformance. So we've shaded 3 areas there in green, and you can see if you look at those periods that the ASX 300 actually went down during those periods, but the fund didn't go down as much, and we had this wedge growing between us and the market. So it's this defensive characteristics kicking in, giving us an edge and helping us get ahead in terms of outperforming the market. And over that whole entire period, we've achieved this 80-58 ratio, close enough to 80-60, which has equated to 150 basis points per annum of outperformance after fees. So it's quite powerful. The industry likes to look at risk and return in these metrics, so we thought we'd share this with you. This is a comparison of where the State Street Australian Equity Fund sits with respect to its competitors in the Australian marketplace. And what you'll see is that we sit very clearly in that lower risk bucket to the left-hand side. We also have got that outperformance coming through as well. But very clearly that lower risk characteristic is coming through. This is another summary slide that just shows the key characteristics of the fund since inception. The first pie chart looks at where we invest in the market cap spectrum, and you can see there that we typically invest outside the top 20. We don't have to, but that's where we typically find most of the opportunities. And you can see those other ratios popping out there. So we've basically got that upside downside capture ratio that I mentioned earlier on, the reduction in risk, the 22% reduction in risk, and the rankings as to where we sit with respect to our competitors in the space. So that we're very proud of the fact that since inception that we actually ranked 9th out of 233 different competitors in the space. Switching gears a little bit, just turning back to the current market environment and on a forward-looking basis, why we think this strategy is particularly suited to the current environment. One of the statistics that I wanted to draw your attention to is just how benign this period has been since the GFC. So we've used this Dow Jones price index to calculate volatilities for each of for the decades over the last approximately 120 years. And you'd probably be surprised to know that the level of volatility that we've had since the GFC is the second lowest on record if you go back over that 120 years. So you have to go back to the 1950s to get a period of lower volatility than what we've had since the GFC. So that's been quite benign. The other statistic that I think is very interesting in regards to volatility since the GFC is that we've actually only had 32% of down months compared to that longer run average of 43%. And that's the lowest ever. So that's just a case in point as to how low vol things have been. We know there's risks in the system, we were discussing those earlier, and on a forward-looking basis, we expected the environment over the next 10 years is more likely to be a more normal level of volatility and a more normal level of market returns rather than what we've seen in this very benign environment. So with that in mind, we think a strategy that is very cognizant of risk management, very cognizant of generating returns through not losing as much, would be really well placed on a forward-looking basis going forward. So on the final slide now, I'd just like to recap the key elements of the State Street Australian Equity Fund. So we are very much benchmark unaware, high conviction. With the high conviction, we do also care about diversification. So we have, at any time, we always have at least 50 positions in our portfolio. So that's quite an important point versus some other high conviction managers. And we're very much focused on the risk and return associated with our companies that we're investing in, and that manifests itself in these more defensive types of returns that we generate for our clients. So if you're interested in this style of investing and you can understand why it might make sense on a forward-looking basis, then there's some details below that I'm sure you can follow up with our State Street advisors. And also thank you very much for joining me today.